Good morning, everyone. This is Neil Sperling here with Financial Markets. I'm so pleased to introduce Elaine Marvin. She's a CFP and she is with One America, and we're going to learn how to use qualified dollars to fund long-term care. And so I'll turn it over to Elaine. Go ahead.
Thank you very much, Neil. I really appreciate your time, and I know your time is valuable, and even though everyone's sitting at home, we'll try to probably get through this in about a half an hour. Would like you to hold your questions until the end if that's okay, and we'll try to address them at that point in time. So hold on here. Here we go. So first of all, what we're going to be talking about today is the asset-based LTC solutions, and specifically focusing on how to move qualified funds. So that's always kind of an intriguing concept for people, taking a lump sum of money from an IRA or a 401k. How does that work? So we're going to get into that, but before we do, we're going to talk a little bit about the background of the product. We're going to talk a little bit about positioning, having the conversations with LTC, and with this product in particular, and then we're going to talk a little bit about, again, how this funding qualified funds fits into the mix. First of all, this product is not brand new to the marketplace. It's been around since 1988. I like to point out to everybody I was there, so I'm the longest running wholesaler you'll ever probably talk to, especially since I've stayed with the same thing for my entire career. But one of my agents calls me the godmother of asset care. I take that as a term of endearment, so I like to continue to say that. But it's just a solution that tends to make a lot of sense for people when they want to address long-term care. And the way we go about it is a very different way, and the way we go about moving qualified funds is a very, very positive thing that we're able to do. I actually started my career with a company called Golden Rule. That's where we started this policy. We became part of One America, a mutual insurance company, about 14 years ago. It's very nice to be part of a mutual, especially in volatile times. We don't seem to have as many stresses on us during these kinds of, again, during this type of volatility. So very strong company, again, been around a long time, over 130 years, and just a great mutual insurance company. And who's your company at that? What I want to talk about, first of all, is just long-term care in general. You know, when I first started, and a lot of you have probably been in business for a while as well, if you had gone out and talked to people about long-term care 30 years ago, I mean, it was one of these conversations that everybody was approaching with facts and statistics. And there's a statistic here that, again, 70% of people now over the age of 65 will need care. Well, if that's a statistic, which is pretty dramatic, you would think that everybody by this point in time would have a solution in place for long-term care. The reality is they don't. And the reason is because it's really not a logical decision. It's an emotional decision. And that's really what I see people doing a lot, is trying to focus on statistics in long-term care. They're not trying to focus on the emotions and the stories that people have. And yet we all know that we're pretty much in a storytelling business. So the thing that you want to think about when it comes to putting a plan in place for long-term care is really what the family has been through, what the client has been through with a family member or a friend. And that's going to really kind of dictate where the conversation is going to go to. If I had a choice between talking to an 80-year-old that every person they know died in their sleep and a 40-year-old that's got two parents with Alzheimer's, you tell me which one is probably going to be the person I want to talk to. The 40-year-old probably understands this risk a little bit more than the 80-year-old, even though, again, their chances of needing care become a bit greater as they get older. But it really is a risk that has much more of an emotional component than it is a logical component. But with that said, if I had a group of clients, 30 clients in a room 30 years ago, and I asked how many people in the room had had a family member who had needed professional home health care, care in an assisted living facility, or care in a nursing home, 30 years ago, maybe one hand would go up. Now, if I ask that question of a group of 30 people, maybe one hand does not go up. So it's something that, again, is more apparent. People are more, realistic about the possibilities of needing care, but that still doesn't mean it's something that they're going to want to, pull the trigger on. But the real situation is this. It's the impact that long-term care without a plan has on a family. So if you look at this little diagram here, for most people, if you call your clients up and ask them, do you have a plan in place in the event that you had an extended care event? Most of them are probably still going to say no. and for all of the same reasons that we'll talk about here in a minute. But if they don't have a plan in place, then here's what happens. It's the family that usually starts providing the care until they just can't really physically or emotionally do it any longer. You see it tear families apart. Again, suddenly it's one family member. It's usually the person that's got the power of attorney. All the responsibility is put on them. And suddenly there's all kinds of resentment that ends up happening amongst family members. And again, people putting their careers and their families on hold, and the impact of not having a plan. When the reality is, this is a very, very positive way to go about, again, addressing a pretty negative topic. But we've all heard stories of families that have been torn apart. They don't speak to each other anymore because, again, there wasn't a plan in place. You know, if a family member gets in a car wreck, there's a plan. If a family member has a hurricane, I'm from Tampa, Florida. You know, if we have a hurricane, we have a plan. But when it comes to extended care, most people do not have a plan. And so then it's, what are we going to do now? So these are some questions to ask. You know, right now is kind of a strange time to be talking to clients. I get that. I find that a lot of people are telling me they're just having conversations with their clients, that the clients want to talk. They don't necessarily want to talk about financial issues, or maybe they do. But now is not a bad time to say to a client, if you're just calling to touch base with them, you know, I do have a topic I'd like to talk to you about. Maybe now's not the time, but maybe in a month or two, I would like to talk to you about this. And then you might be surprised how they might say, no, actually, I would like to talk about that now. I've got some spare time. So again, this is a one way to go about approaching the conversation. So I'm going to give you two questions here. And the first question is, you may never need care, but if you did, how would that affect your family? So, you know, how would it affect the spouse? I always love it when I get a person who says, oh, you know, I don't need to buy long-term care. I had a gentleman one time actually say to me, again, I don't get to do client work any longer. I used to do a lot of joint client work with agents. But I did have a client one time say, oh, no, I don't need to buy that. That's why I married her. At which point in time she looked at him and said, are you kidding me? So, again, there's sometimes these unspoken plans in place that people are not always on the same page with. But again, how would it affect a spouse? It can be very, very physically taxing and emotionally taxing if a person's having to provide care 24 hours a day. Again, how does it, when it comes to children, when I get people that say, well, my kids will take care of me, I think what most people really want is their kids to monitor their care or facilitate their care. They don't really want their kids to physically be the person that actually takes care of them. You know, they want their children to visit them. They want their grandchildren to visit them. Those are the important things. Again, if it is the family dynamic, the fact that it's usually the one, there's just one, and everybody knows who that one is, that ends up picking up the majority of the burden here. And again, the other thing too is, why do it that way? Why pay for long-term care out of pocket when there are very, very positive ways to go about, avoiding a huge amount of losses, by just strictly betting the farm or not having enough long-term care in place. So those are some of the things, again, that people can think about when it's, how would it affect your family if you didn't have a plan in place. So the next question, and this is going to lead into our solutions here, is if you did need care, how would you pay for it? And you know that, again, a lot of the opportunity when talking to people about extended care is actually listening. There are a lot of people out there that if you ask them, they think Medicare is the solution for long-term care. So there's an opportunity to educate there. Most people, if you ask them about long-term care, they're really only familiar with traditional, regular long-term care insurance. That was the majority of types of policies that were, in 30 years ago here in Florida. There were probably 100 insurance companies selling long-term care back then, traditional, regular long-term care, and now not so many. But again, and the reasons are, again, the market has just shrunk for lots of different reasons. But for the most part, what most people, if you ask them, how would you pay for it? Most people are thinking of just using their assets to pay for their care. And so if you ask them, well, if you needed to, earmark $100,000 or $200,000 to pay for your care, what would you liquidate first? I mean, that is one way to start this conversation, is you tell me about your portfolio, tell me about your assets. And then what we'll do is we'll come up with a plan that maybe would be better than just betting the farm. So the idea here is for most people, if I ask them, where is the money going to come from if you needed to earmark $100,000 or $200,000? Again, most people will say maybe money in the bank, but most people these days are going to say my IRA, my 401k, my TSA. So what I want to do is talk to you a little bit more about the risk, and then I'm going to get a little bit more into how this positioning of a single premium would work for your clients. So I mentioned earlier, again, a lot of times most people were only familiar with regular traditional long-term care insurance, where you pay a premium for a stated benefit. But the problem with that has always been this one phrase that comes up over and over again. And I know someone out there is getting ready to say out loud, even though I can't hear you, they hate the idea of spending a premium for something that if you don't use it, you lose it. That's just been the phrase that's been tied to long-term care insurance, regular, traditional long-term care insurance for years. So if you ask people, why haven't you bought long-term care insurance? No matter what the answer is, it's going to lead to really that they just didn't want to spend yet another insurance premium for something if you don't use it, you lose it. So the concept behind asset-based LTC and what we do is, first of all, we tie it to a life insurance policy where you can use 100% of your death benefit if you need professional home health care in an assisted living facility, or care in a nursing home. So quit, live, die. Somebody gets something one way or the other. I mean, there is 100% chance, Mr. Client, that we're going to pay this someday. Do you agree? I mean, that's not one that you can have to debate. It's 100% chance it's going to happen. Someday a person's going to pass away, and what they haven't used out of the death benefit is going to go to their beneficiaries. But there's a 70% chance we're going to use this during their life if they need care. We're going to use it tax-free. That's a pretty positive thing right there. And if they quit the policy in the future, if we're the last asset on their balance sheet and they need this money to pay for their food or their rent, then we've got a guaranteed cash surrender value for them. So somebody's going to benefit one way or the other on this policy. So it really overcomes the objection of, again, what happens if I don't use it, I lose it. The second big thing, and actually this has become probably our biggest plus right now, is that what most people don't like about traditional regular and long-term care insurance nowadays is the potential for rate increases. Either they've had neighbors who've had them, or just the reality that a policy can have a rate increase. Well, the way our policy was designed, it can't. So the premiums are guaranteed, the cash value growth is guaranteed, the death benefit is guaranteed, the surrender value is guaranteed. I had an agent one time say to me, I don't think I could use the word guaranteed. I don't think my compliance department would want me to use that word. It's like, no, you can use the word. It's there. It's guaranteed, guaranteed, guaranteed. Personally, I've told you already, again, they call me the godmother of asset care. That kind of implies how old I am. So I am getting much older. I'm getting closer to retirement. And as I get closer to retirement, I can tell you that financially, I want more knowns than unknowns. If I buy a regular, traditional long-term care insurance policy, is that a known or an unknown? Well, it's really an unknown because I don't know what the price is going to be in the future. If I don't do anything at all and I bet the farm, is that a known or an unknown? Well, it's an unknown because I don't know how much money I'm going to go through. But the great thing about this policy is because of all the inherent guarantees that are in it. If you don't use it, you don't lose it. Again, the guarantees are there. That is definitely a known, and that's the positive to this product. And it's, to be honest with you, it's becoming probably the biggest buzzword about our policy, more than even anything else that we do. This is the big thing too, though. It's that we don't sell our policy just individually. We can sell it jointly. Now, over the years, for those of you that have sold with us before, if you're listening, in the prior years, we used to have a little bit more liberal definition of what joint could be. But now we still do joint, but it does need to be married, domestic partners, or civil union. So we've kind of tightened up on our definition a little bit more than what we used to be able to. Again, it was a little broadly defined in prior years, but we still sell joint. But here's the big one, and that is this. I spend probably, I don't know how many hours a day, but somewhere along the line in a conversation that I'll be having with somebody, the concept of average term care pops up. and I'll start hearing somebody giving me a statistic like, well, the average stay in a nursing home is only 2.5 years, or something along those lines. I want you to think about insurance for a minute. It's not usually sold to the averages. So why are we selling long-term care to the averages? I mean, we can still show people how to get lifetime benefits. If the big one happens, we're on the hook until the day the person passes away. So if you buy our policy and you buy the lifetime option, again, we can pay the claim for the rest of the person's life. If you need a statistic, the average Alzheimer's stay now, average is 8 years. 8 years is about 100 months. That's a lot of care. So again, thinking about long-term care, I think the big plus for us, sometimes we get people that show people options. I think that's a good idea. So if you're showing your client a 2-year, a 3-year, a 6-year solution, might want to position it right along with us and show, again, the lifetime option. And that way, if the big one hits, again, we're on the hook for the person's entire life. I want you to visualize this for a minute. I of course, do mostly public speaking, so talking on webinars over the last 5 years become, again, more prominent. But I want you to visualize this picture. You're standing in a bucket of ice water, and your hair's on fire. On average, you're probably feeling okay. So again, averages are just not something that you want to really think about, especially if you have the ability to, again, show a person a long-term care strategy with lifetime benefits. So that's, again, one of our big aces. I like to call this slide our wow slide because I think it really kind of covers the essence of all the things that we can offer in all of our product line. So here's the concept. This is our busy screen here. But again, I want to kind of start here and kind of give you the idea of how our policies work. And then I'm going to spend the rest of the time that I have with you just focusing on the qualified idea, the way to move qualified funds. So as we mentioned earlier, I said, if the client needed to earmark $100,000 or $200,000, where would it come from? So what they would do is they would take that lump sum of money if it's sitting in the bank, and they would move it into our policy. Now, what that would be doing, first of all, is buying a death benefit in a life insurance policy. Or we can do this with an annuity-based contract as well. So for somebody who doesn't like the life insurance side of it, we have strategies in place to do this with an annuity-based. And so the idea here is you're going to use that death benefit first. So that premium, that single premium or that recurring premium, however you pay for our policy, it's going to first of all buy a death benefit. And depending on how, and again, that can be, or it can buy a value in the annuity. But that benefit would be paid out depending on the case strategy that you go with. It will be paid out over 25 months, over 33 months, or over 50 months. So that would be, again, step one. But the rider then can either be packaged into it by putting part of the single premium into this rider, or you could pay for the premium again on a recurring premium. So again, you could do a 5-pay base, a 5-pay rider, a 10-pay base, a 10-pay rider, a single pay base, a single pay rider. So there's different ways to design our policy, but the essence of the policy is when you go on claim, you use the death benefit first, and then the rider will continue to pay the claim. Now, we don't have to do lifetime. I had a gentleman call me up yesterday, and his client had a 25-month base and a 25-month rider. Well, that's okay, but I really, really tried to emphasize why don't you show your client, it is going to be more expensive, but why don't you show your client how to get that lifetime benefit on a premium, again, guaranteed never to go up in price. So, again, that's just the essence of our policy. You're going to use the death benefit first. It'll go to zero. Once it's gone to zero, then again, the rider will continue to pay the claim. Now, if there's 2 lives, it can be, again, you're going to use that first bucket of money first jointly, and then the rider will continue to pay the claim, and it can continue to pay the claim for both of them if they have, again, a joint policy. So a lot of this stuff is stuff that you're going to want to, bring up with your internal or ed or whoever it is that you work with at the agency there. But again, the case design can be done in multiple different ways. The big thing, though, is if I had somebody who was taking money from again, $100,000 from the bank and buying this policy. That's not really that big of a challenge from a tax perspective. It's going to create a death benefit. Again, it's going to create this COB rider, but it's not as big of an issue as it would be if I were to take $100,000 from my IRA, my TSA, my 401k. That's where the big issue comes up. So if I was wanting to do this on a single premium basis, normally what you would have to do is you'd have to pay taxes on that entire amount in 1 year. Well, most clients aren't going to want to do that, correct? So we happen to have a strategy. We call it annuity funded whole life. And I like to call it actually IRA funded whole life because, again, it is an individual retirement annuity, but the majority of the people that buy this strategy, they're moving qualified funds. And it's going, again, first of all, into an IRA with that. So what happens is you take that lump sum of money. Again, it moves it into this policy, but instead of paying taxes on 100% of it at one time, we're going to basically give the client a 20% premium bonus, and then we're going to spread the taxes out over 10 years. So again, I'm going to go into a case study here for you for a second. But again, this is a great way to spread the taxes out. So I want to give you a little story, and then I'm going to go into a case study here. We created our policies over the last 30 years. They came in over time. So first of all, it was single premium, mainly just a CD alternative concept. And then again, we went into ways to pay in over time. But then we came up with this strategy to move qualified funds. So early on, I had gone out to help an agent with a case. It was in Lakeland, Florida, not too far from here. Went out to see the client and with the gentleman, and the client loved the concept. But we did not have a way to move his qualified funds. Well, we don't need money to underwrite, but I kept asking the gentleman over and over again, where's the money going to come from to pay for this policy? He kept saying to me, oh, honey, don't worry about it. I got the money. So we got him underwritten, he and his wife. When we went back to get the money, the gentleman said, well, this isn't a 501c3 hospital pension plan. Do I have a problem moving that money? Of course, I had to say, well, sir, if you do that, you're going to get a big tax bill this year. And he said, well, I don't want to do that. When we were able to go back to him, when we had the qualified strategy that I'm going to describe to you here in a minute, when we were able to go back to him and say, hey, would you still be interested in doing this policy but spreading the taxes out? He said, sure, that's not a problem. I love the idea. I just didn't want to get hit with all the taxes in 1 year. So that's really the magic to this policy. It's being able to open up this solution to so many people who didn't even think that they could do something like this. So the meat of this policy is, first of all, we've attached an income rider. So we put a 20% premium bonus, income bonus on this policy in the beginning, which again, that's a pretty powerful thing as well. So, and on top of this, what's going to happen is the taxation issues, we're going to spread the current income tax on the qualified money out over 10 years. But if they need long-term care, they've got a tax-free benefit out of the gate here. And that's, again, a really neat way to leverage their monies and create a different purpose for just a portion of their qualified funds. So in this example, we've got $150,000. We're going to move it into our policy. We're going to add a 20% premium bonus onto this, so it's going to create $180,000. But instead of getting taxed on that in 1 year, they're going to get taxed on $18,000 every year for 10 years. So one of the things that they're helping to do is they're really kind of helping to prepay the tax liability that their kids are going to inherit. Somebody's going to have to pay the taxes someday anyway. And now with the new Secure Act, again, having monies with purpose may be even a more powerful idea for your clients. So just to kind of give you an idea here of what we're talking about from a numbers perspective, we've got an example here of a 61-year-old male and a 60-year-old female. Again, they take the $150,000. We're going to tax them on $18,000 per year. It's going to create $5,287 per month per person, tax-free for LTC. So if he ended up with the average Alzheimer's stay, as I said earlier, which was 8 years or 100 months approximately, and she also ended up with that same average Alzheimer's stay. And let's again just say that's the big one that affected both of them. this strategy would have created $528,000 of tax-free monies for his care and $528,000 of tax-free money for her care. So in this example, $150,000 qualified fund created over $1 million in benefits in this example. Now, again, one of them might not have needed care for this long. One of them might have needed care for longer. But what you don't know, again, is how long of a term the care is going to go for. So this is just such a powerful way to show somebody a way to move a portion of their qualified funds and address one of the biggest the threats they have to their assets the older that they get. So this is just showing you an example of how the proposals look. So again, if you click the policy, there's a cash surrender value. The death benefit is earlier in the higher years due to the fact that the annuity still has a value to it. But you'll see that the guaranteed death benefit is $176,000. And again, it's the death benefit that drives the LTC benefit. So with that said, I want to go ahead and open this up for questions. I think one of the things about this is, I'm sorry, it's really, it's really a very powerful way to go to somebody and say, again, tell me about your assets. What would you use to self-fund, again, if you were to be a self-funder? And again, if you had qualified funds, this is just an excellent way to spread the taxes out. So go ahead.
That's great information, Elaine. And if you have any questions or would like to address some topics here, go ahead and use your question function within your GoToWebinar control panel. Just type out your question and we can address that here on the call. And we'll also be following up with you via email and telephone call for those who attended here today. But just want to show you on your screen here, you can see the financial markets website. There's no questions as of now yet here, Elaine. But on our website, fmiAgent.com, if you'd like more details on this particular product, log in, click on Product Kits. On the right-hand side here, you'll find One America.
I see Omaha Steak too. Go ahead. Sorry.
I'm sorry.
No, I'm sorry. Go ahead.
And then here you'll find then the asset care product that Elaine was sharing with us. And if you scroll down here, there's a really, really good consumer brochure, the Asset Care Single Premium Annuity Funding Whole Life brochure, which is really what Elaine was going over here with us today. There is a question, Elaine, here coming from Olimpo, excuse me. How does the tax deductibility of the premium affect 10-year tax liability? The tax
well, when it comes to the tax deductibility, like what you have with traditional regular long-term care insurance is you have, if it's an itemized deduction for individuals, when you do our policy, like the base policy, where you do just a single premium, or if you do the recurring premium, so let's just say you 10 pay the base or single pay the base, and then you 10 pay or whatever on the rider. I'm so sorry, I'm stumbling around here. The rider, the COB rider, would function like a traditional regular long-term care policy. So it could be subject to some deduction, but for most individuals, there's not a huge deduction. I mean, it's got to be an above-the-line deduction above either the 7.5% or 10%. So again, that's the way it would work, but it's only on the COB. But again, the COB, which is very similar to traditional regular long-term care insurance, so that's why it functions that way. So on the policy we just went over, on the annuity funded whole life, we don't break out the COB, so it would not, there would not be, again, much deduction that people can take. But again, it's an above-the-line deduction for individuals. It has not been a huge market for us anyway, unfortunately. Years ago, we always wanted it to be, again, we wanted it to be not itemized. We wanted it to just be a deduction, but it's not that way. So we do have a really good booklet if you're looking for sales tools and looking for the taxation issues on these policies. We have a really good booklet that's advanced strategies, and I can get one of those over to Neil and to Ed. and they can get that out to you. But it talks about all of the tax issues that would pertain to this policy. But keep in mind, the biggest tax advantage of this policy, if I take $150,000 of tax qualified money and I don't buy this policy, go say that's the money I'm going to use. When I go to use that, I'm going to have to pay taxes dollar for dollar off of that money. The strategy that I went through and showed you, the way to create $5,287 tax-free for that, again, for that couple, for each one of them in that example, the tax benefits off of this are huge. So again, going into retirement, people have so much in taxes that they're going to have to pay off of their qualified funds. To leverage this into this tax-free benefit for people, again, I think it's just a huge, that's probably our biggest tax aspect of our policy, more so than any deductibility off of the rider. Are we good there?
Very well addressed. Thank you. There's another question here, comes from Noel. Maybe I missed it, but the death benefit, how would it be taxed if using qualified funds? Still taxable?
No, well, what happens is, good question. So that guaranteed death benefit of the $176,000 in the example that we were going to, that's going to go to the beneficiary income tax free. Now, the remaining balance of the annuity, so let's just say, again, it got down to $100,000 that was in the annuity. Let's say they both died 4 years into it or 5 years into it. The balance of the annuity would still have tax issues on it. But the death benefit, it does create an income tax-free death benefit when it comes to long-term care. The little story I went through on the gentleman in Lakeland, Florida, I mean, one of the things he said that day to us, which was a very powerful statement, I always love to repeat it, is that on top of everything else, you're helping me to prepay some of the tax liability that my kids are going to inherit. But you're also going to provide me with this income tax-free benefit to them to help them deal with some of the taxes that might still be in the money. So you want to play around with this. There's a calculator that you can go to and play around with the software. But the more you look into this, you're just going to see this is a huge, huge, huge benefit. It's a huge tax benefit for people. But the death benefit, the actual life insurance death benefit, that would be going to the beneficiary's income tax free. So I hope that answers the question. So in this example, the total death benefits, the $230, but that should include an IRA. It'll be a little bumped up a little bit higher in the early 9 years because of the IRA that still has a value on it. Man, I swear I had coffee this morning, but I don't feel like I had enough. Go ahead.
You'll get that tax-free death benefit. In addition, you'll get the balance of the annuity.
Exactly.
If the annuity has not yet completed its 10-year funding.
Exactly.
Yeah, incredible. Yeah, and that tax guide that Elaine had referenced, the Advanced Strategies Guide, we'll have that posted here at fmiAgent.com under the product resources. That'll be posted there a little bit later today, so check back on that. Also, a thing that Elaine had mentioned is that calculator where you can run quick quotes. That is also available right here in the upper right-hand corner of the One America page, the Asset Care Calculator. So, yeah, definitely take advantage of that with your what-if scenarios and working with your clients. There are no other questions as of now.
I would like to address one other issue. I'm so sorry, Neil. I didn't mean to interrupt you there, but I did want to go ahead and address one other issue. We did find out at the end of the day yesterday, and I just shared this with Ed probably about an hour ago, that we are going to be making some temporary changes because of the COVID situation. It's primarily addressing people that are over the age of 70, but it doesn't have any impact on the strategy that we went through today with qualified funds. So that is still available up to the age of 80 on that qualified idea. But again, Ed has the announcement for the changes that we're making for any of the listeners that want to kind of hear about that as well.
Is it short enough that you could surmise it real quick?
Sure. Basically, what we're doing is when it comes to 70 and above, we are going to be not taking any type of recurring premium. It does not affect 69 and below, but we can't take a 5-pay, a 10-pay, a 20-pay. It goes into effect on May 1. We will only be doing on those older ages single premium. So again, that's why the annuity funded whole life today is fine. So we will be doing single premium base and rider only on the 70 and above group. We won't be able to take anybody rated. So one of the other powerful things about us, rated over the age of 70, the way we go about underwriting is we're very, very reasonable. It's not like we are easier. It's just we're reasonable, and we have an ability to rate. So, but we are not going to be able to take rated cases over the age of 70. And it's temporary. Again, we don't know when it's going to, we all don't know when, but currently that's what we're doing. So and again, we have until May 1st, so we didn't do this hard stop. You have until after cases need to be received by May 1st. If there's anybody that's working on one currently that's like a recurring premium over the age of 70.
Okay, good. Thanks for that. There's a couple other questions, but before that, is it based upon the date the application is received in your office or the issue date?
No, the date received.
The date received. Okay,
so
folks, if you have any 70 and above and you want to explore some of those continuous pay options, which, again, the premiums with One America, fully guaranteed. And so you can do those limited pays, or, of course, you can do single pays certainly after May 1st for those 70 and above. Next question here comes from Ross. I missed the first part of the presentation. Do I need to be licensed to sell long-term care?
Yes. Most states are going to require that you're going to have an LTC certification requirement.
And so your continuation of benefits and the long-term care benefits are actually qualified long-term care rider definition.
Yes.
I
mean, and our policy, okay. That's the other thing. I mean, we're not we are what's called technically a 7702B definition for long-term care. So when you're reading our policy, it's like you're reading a long-term care policy in a lot of ways, and then you start reading about life insurance and cash values and all of that. So, you can call us long-term care all day long. That's what we are. We just happen to be tied to a whole life policy or to an annuity-based policy. So, but for that reason, yes, we are long-term care. So you need to, if your state requires you to have long-term care, you're going to need it. And if you do this annuity-funded whole life, because there's an annuity component to it, if there's any annuity training that's required, you're going to need that as well.
Yeah, very well said. Yeah, you got to have that. If your state requires NAIC annuity,
yes,
the 4 hours there, you'll need that as well. And also to mention, Elaine's portfolio also includes annuity care, and I know we didn't really touch on that here today, but that's a product that does not have the whole life component, but you can use standalone annuity dollars to leverage for the need of long-term care as well.
That policy, we always, I think everybody gets into habits, and insurance companies, believe it or not, we all get into habits. But the annuity-based portfolio that we have with the annuity care and the indexed annuity care, those products, huge. It's a PPA-compliant annuity. If you've got a client that's got an existing annuity and they 1035 it to us and it's non-qualified, we can make it tax-free for LTC. It's huge. And we can write that policy up to the age of 85. So if you have clients in that 70 to 85 age group, it's perfect solution for them. And the underwriting, we still have a phone call interview, but we're either going to take you or we're not. So it's a much simpler underwriting process, which is important these days. Makes it, so yes, I agree. It might be a topic for future, webinars for y'all, just to focus on just this annuity care option. Again, lifetime benefits. You can go to an 81-year-old female and show her a solution, especially if she's got an existing non-qualified annuity with gains. And again, the underwriting on it's reasonable. It's basically 8 tables that they can still get the policy. I can't have, like I've got one right now, the gentleman didn't get through the phone call due to memory issues. But anyway, that's of course going to be our big no-no. Of course, it's all understandable here. But again, we're very reasonable. And we have a nice tool called a pre-underwriting inquiry form. Again, you guys can direct them to that as well. So if they have questionable health before you even go down this path, you can run a health condition by our underwriters. Yeah, it's a pre-underwriting inquiry form.
Inquiry form right here on the screen. And so you'll also have access to the annuity care material there at fmiAgent.com as well.
And one of
All
the
right,
things they'll
Elaine.
do, if you send
Go
that
ahead.
pre-underwriting inquiry form in and the client, if we can't take them on the life-based side and that's what they were interested in, they'll let you know in that inquiry form whether or not annuity care might be an option.
And they're very responsive as well. So if you get that to us, we'll generally be able to turn that back to you within 1 to 2 business days. So they're just super, super responsive at One America.
Thank you.
All right. There's no other questions coming in, so I think we'll wrap it up. Is there anything you'd like to finish doing closing here?
Well, I just want to say I love working with your office. So those of you that work with, all of the people there at fmiA, I know you know what I'm saying here. They're great people to work with. So again, I appreciate your time today, and and please stay safe. And again, thanks again.
Thank you so much. And if you'd like any more information, hit the website or contact your internal wholesaler here at Financial Markets. Thank you so much for your business, and I hope you have a great end of the week.